Bluechip Dialogues. I'm Garett Jones, your host. I'm the chief economist at Bluechip. We're an independent stablecoin rating agency. We rate stablecoins for their economic safety. We give them letter grades from A plus through F. We've given many Fs, but no A pluses. Today, our guest is Michael Svoboda. He's CEO of Liquity AG, which is a stablecoin project that actually produces a rare product, a DeFi stablecoin, one where code is actually law. The early world of crypto is a world where people really thought code would be law. In practice, the big stablecoins tend to be those that hold fiat assets, that hold things like US treasuries, and that are heavily regulated by the laws in their country of origin. When we at Bluechip rate stablecoins, we actually have to have a big fork in our rating system between the fiat-backed stablecoins and the DeFi stablecoins, precisely because we take seriously the claim that for DeFi stablecoins, code is law. Liquity here has a new product called Bold, and that's what we're here to talk about today. Please, Michael, tell us a little bit about Liquity and Bold.
Yeah, thanks for having us, Garett. Yes, Liquity is a borrowing protocol. Firsthand, you can borrow against your Ether and staked Ether, and you get a stablecoin called Bold. That's how the stablecoin gets into existence. User mint it, so it's very similar to Maker. People that know Maker or DAI. And it has a long history. It started 2021 with the first version, and there the founder, Robert, really had the idea. He liked Maker, but he said, why do we need a governance? We have code, we can do that autonomous in an automated way. That's what he set out, what he built back then. Protocol had more than 5 billion in assets. And in the meantime, we created a V2, which is similar, which is more dynamic, improved on some aspect. And that's exactly, as you said, a Liquity V2, we call it, with Bold. The stablecoin, truly digital stablecoin. Or as you compared it to the other ones, you have bank-linked stablecoins that are linked to banks and other stuff. And this is really a truly crypto-backed, so the backing is only on-chain. That's why I call it, it's truly digital dollar. The others aren't necessarily digital. It's if you say you have gold is in a vault and then you have Bitcoin, that's digital gold. So I would call really Bold a digital stablecoin compared to the others that are more like gold that is held somewhere in a bank, in treasuries, and then you see a digital number in your e-banking, but it's not truly digital.
Yeah, so just to get the audience up to speed here, so Tether and Circle USDC, these are the two leading stablecoins, and they're both fiat-backed. They're basically overwhelmingly backed by US treasuries. And so when one, of course, it's impossible to electronically move around a treasury. All one moves around there is the title to some kind of a claim to that treasury in certain events, in a sense. This is what economists would call narrow banking. That can be a very safe system. We've given solid grades to fiat-backed stablecoins. Of course, that doesn't make good. That doesn't put paid to the promise of the original world of cryptocurrency, where, as Larry Lessig of Harvard said, code is law. So how do you actually test the code to make sure that it'll be robust enough to get something like a good grade and to be safe for users?
Yeah, sure. Maybe first just to double down on what you said. My goal is not to say that other stablecoins or CeFi stablecoins are bad, more to educate users that these are really two different things. And I really like it. You also rate these CeFi stablecoins. And there are differences that people maybe not understand. Why a PayPal dollar is maybe a bit safer, gives you less risk than a USDC, which is interesting. But they have like completely different profiles, and especially different risks. So I think that's the interesting part, to understand how the risk differs. It's not that it's bad, that it's a treasury and so on. It's, as you said, that a narrow bank is something great, and that the PayPal or Paxos dollar is the best dollar you can hold. So it's really great that they have it. It's better than having in your bank. But I think what will be interesting to look at is the different risk profiles, the different controls you get, and the different peace of mind or transparency that these two worlds give you. Just to double down on that, but now, yes, as you said, so these bank-linked or bank-backed stablecoins, they get their trust by regulation because you trust intermediaries or people or custodians and so on. And as you mentioned, our crypto-backed stablecoin that is just run by the Liquity protocol, which, by the way, is immutable. You can't change the rules. You can't upgrade it. So you have perfect predictability. Nobody can change it. But as you said, that means we can't change the code. So you really need to make sure that the system works, because that the rules will be enforced as they are there. And that's why you also don't need a regulation, because what do you want to regulate? You don't have any wiggle room. You don't have any humans that can change anything. So it's really about trusting the code. And I think there it just needs a lot of, you said you're an economist. I would say it's like a code economist that can figure out how the system works, how you can create the balance between supply and demand, how you manage risks. So all the things where you usually have humans. So if the collateral isn't good, what happens there? How are redemptions done? You need to translate that in code. So first you need a good system design, and then very versed engineers that can create safe codes, and then also auditors that can think about security, but also what's the really hard part, and not many projects have done that to create immutable projects, is you need to think of the long tail of all things that can go wrong. Because usually you could pick up the phone and then solve it. With Liquity, you need to have thought in advance. Once we click the deploy button, kind of the wiggle room is away. So I think, as you said, the design, good team, all the edge cases, and then auditors. I think these are the four facts, and really a team that has done that over and over again. And that pays also to the fact a bit that there aren't many designs. And Liquity V1 and now also V2 is like the go-to model to create these DeFi stablecoins, the blueprint. And just because it's not so easy to just say, oh, I create a new one and I thought about all these things, that shows also a bit the expertise that it needs, and that it's very hard to replicate to come up with such a new system.
In the CeFi stablecoins, the fiat-backed ones, the ones especially that are here in the US, they have to go through a bunch of, if they want to pay interest on those coins, they actually have to go through some kind of rigmarole of calling it rewards rather than interest. Liquity, the Liquity Bold is going to have a different way for people to earn interest, just like much more like a savings account. Tell us a little about that.
Yeah, that's really interesting, especially with the Clarity Act. Now they want to protect the banks because they say, hey, you're stealing our business model. And that's the beauty. We are in self-service finance, in peer-to-peer finance. So we designed a system that just connects supply and demand of the stablecoins and just say, okay, we have two sides of the stablecoins. One are the borrowers that mint the stablecoin, that want liquidity against their ether. They're paying interest. That's a service for them. And who are they paying the interest to? To the stablecoin holders, because they give them the cash. They hold the stablecoin until they come back and pay back the loan. So it's the natural thing, and it's so obvious. But honestly, it's interesting. No DeFi stablecoin has built that like that, and nobody passes 100% through to the stablecoin holders. So that's something you can only do in a coded system to make that so simple and direct. So if I hold the stablecoin, I can deposit it in the protocol and I earn the interest of the borrowers. And the very cool thing, I think you almost get it nowhere, because I'm still in control of my stablecoin. So imagine I'm just depositing stablecoins, I'm holding control of it, can withdraw the full amount, yet still I earn an interest. Because usually earning interest means somebody takes your stablecoin, does some magic, and gives you then the yield. So for me, it's really a DeFi savings account, or almost like a DeFi treasury. Not a risk-free yield, you have the technical risk, but very little risk attached to earn yield in DeFi. And I think that's the beauty, to get a very uncorrelated yield with a totally different risk profile.
So on that term peer-to-peer finance is a very good term. I'm old enough to remember Napster, the peer-to-peer music sharing network, and we know what happened with that legally. It wound up it lived through many iterations, right? It lived as a sort of legally tolerated peer-to-peer, then there were lawsuits, then it became corporatized. Do you think that peer-to-peer finance is something that will ultimately be something overwhelmingly appealing to hacker types, people who are very technically deep into the crypto culture? Or do you see this as making it out into the world of mass appeal, where I can tell my grandmother, just go to this website and Liquity is just another stablecoin you can use?
It's an interesting analogy, and I think somehow it doesn't fit, because it was a bit peer-to-peer in Napster time. There you had IP, and okay, there was IP infringement. I think peer-to-peer finance is something else. It's something very natural. Finance 200 years ago was peer-to-peer. It wasn't centralized banks, national banks. That's the natural thing. It should be like free speech. As an economist, you should say people should be able to do that. And just over time, because how money worked, how quickly it went, it started centralizing more and more. And with blockchain, we have the unique opportunity to say, now we get that alternative again. So I think it's here to say it's something very natural as it was before. It just wasn't possible anymore to move physical money in that way. But with digital money, it's possible. So I think it's great. It should stay. We should have this option because it makes us less dependent on centralized entities, governments, and regulators. Is it for your mom? I still think it has a lot of value that we have trusted parties that have a support line and provide these benefits, and people can rely on it. So I'm not saying it's taking over. I still think it's for a group that really cares, is technically feasible, but that really values that. As I said, with Bitcoin, having the digital gold, for some people that's really valuable and it adds additional benefits to traditional gold, but traditional gold is great and for most people probably fine too. So I see it in the same way for digital money, and don't agree on the peer-to-peer thing, saying, yeah, it's something shady. No, it's something very natural. We should have a right, and we should be able, if you and I want to take out loans and facilitate that we are allowed to do that without somebody standing in the middle and telling us what to do and not to do.
Yes, peer-to-peer finance means that people are making these transactions directly. You pointed out that one person just pays interest directly to another person through the protocol. So I got to ask the Economist question, how does Liquity make money here?
Yeah.
What's the business model?
That's a good question. It was in V1, it was different. So we have a token, the LQTY token, and that captured minting and redemption fees. Mm-hmm. And with V2, we improved some stuff. So you can say it's like a public good. So we were able to finance ourselves also with the token. So we shipped that. So now it's a public good. We built something in it that the token holders control 25% of that 100%. That 25% goes to liquidity because that's important. It's like a service you have to pay for as a stablecoin holder and as a borrower. So that's why we funnel that there, 75% to the other one. And the goal is, if we grow that, you can provide liquidity to different pairs. You can get bribes on it. You get a market. You get to control a revenue stream. So to give something back like that to users. And of course, we as a team and as a company are incentivized through LQTY, but we did that in a very soft way. And that's mainly also due to the values of the founder. Okay, that raised the money to build that, ship a V1. A V2 was never foreseen. We shipped it as a public good again. Now it doesn't belong to us. It's there for everybody. We can't take it away. So it was done in this cyberpunk ethos a bit. And because it doesn't need a company to sustain it or only minimal, it also, we want to build it and help to bootstrap it, but then make it more and more dependent on the community and less dependent on somebody. So yeah, we don't need developer right now to do anything. We do some marketing and some education, and that's hopefully also the goal, and we will educate more and more for that. That is also a bit the job of the community to take over and say, hey, we value that. We've seen that with the whole trustless discussion. We value trustless sovereign stablecoins, but that also means we need to use it, we need to take care of it, and it belongs to everybody. And that's also a bit the sign of this ethos.
I'm going to turn to the governance questions in a minute because the governance rules for Bold are a little bit different than those of Liquity. But first, I want to talk about something that's come up in some of the videos that I've read by Liquity staff, where they're explaining how V2 Bold was going to work, and this idea of a reference interest rate that basically individual people can bid or will have a sort of bidding market for interest rates in the Bold protocol. But I think the idea here is to aggregate that in some way to create a reference interest rate for true DeFi, non-fiat linked lending. Tell me a little about this idea of a reference interest rate, how people will be able to learn about this and see what interest rates are in DeFi.
So the cool part is, how does it work for other stablecoins or borrowing lending market? Who sets the rate? Either you have a governance, again, somebody's voting, or you have a utilization rate, how much liquidity is there in the pool. And then we said, okay, how do we set the fair rate? Because that was a bit the problem in Liquity V1. It was set to a minting fee, one-off fee, not an interest rate. That worked with a low interest rate environment, but didn't scale. So for V2, that was the main change. How can we create the right rate? Mm-hmm. And you're an economist, so who sets the best rate, the right rate?
I like auctions, right?
Auctions or the market. The market.
Yeah.
So we gave the opportunity to the user in Liquity V2. The user sets the rate, so the borrower. Mm-hmm. Each borrower can say, I pay that much, And of course, everybody, there's a twist, would set the lowest, but we created an equilibrium. That's how the market rate should then emerge. So everybody can set the rate. So you have a list of rates, and the one with the lowest, he has the best deals, but he has also the biggest risk or the biggest pain is users can redeem the stablecoin. That's also a feature. They can instantly go to the protocol and redeem. No KYC, everybody can do it. And they will just exchange the dollar, let's say 100 BOLD, for 100 BOLD worth of collateral like ETH. So it's not a liquidation, it's really a swap. So the borrower only loses his exposure, but he doesn't like that potentially. And that's like the stick. Stablecoin holders have a way to say, hey, you're paying too little. I get more on the market. If you don't pay, I redeem. I get rid of the stablecoin. So the borrowers are now incentivized to say, please don't redeem me. I increase my rate. And that's how these supply and demand side can find, that's what we call the market rate. So there could be then the average rate. And if enough users use it and are quick enough, that should emerge because there are just market forces and no disturbance. So then stablecoin holders will hold the stablecoin if they are compensated fairly. This means the borrower needs to set the right rate. If I get 10% on another stablecoin, I will sell my stablecoin, and then it will depeg, people will redeem, and borrowers will need to raise interest. And I think it's also for the first time that we see such mechanism play out and just encoded. And I think that was really fascinating to see. So right now on our Dune dashboard, you can see that there is a variance. You have an average rate, but you have some that play the safe game, some are really on the edge and can play with that. And again, it's a cool thing. It's like peer-to-peer finance, market forces. So for us, that was also a bit an experiment. And right now it works quite well. I was surprised how well it was perceived also by users to be able to do that.
Yeah, so the experience most people have with interest rates is whether they're borrowing or lending is they go on a website and see what's posted there. And that's really a CFI approach when we think of going to a bank or going to a financial services company. It's very centralized. And for the person offering the interest rate, it feels the only way they have to learn whether they pick the right rate or not is to wait over time and see how many customers show up, right? So if Bank of America posts their borrowing rate a little bit too high, then nobody shows up. So they have to wait for the touch and feel of the market. What you're describing here is much more like over-the-counter financial markets and much more Vernon Smith, the Nobel laureate's double oral auctions, which is the way he runs his supply and demand experiments, which helped him win the Nobel Prize. He was our colleague here at Mason for many years. So like people are just trying things out and they're finding out what the market equilibrium is in the BOLD protocol. And that's what it sounds like.
Yes.
And how will people get information about what rates are working, what rates are not working? Is there going to be something like a live ticker? Is it going to report means, variances, and what kind of data will people be able to see here?
Again, and there we are maybe going back to the differences between a pure DeFi stablecoin and a bank link. So we have three things that are different. One is the risk. That's also your rating, and we can go into that, how the risk profiles are totally different. One is the control. That is different. Okay, I have other mint rights, redeem rights. I have strong property rights that can't be taken away. And the third part is also peace of mind because you have increased transparency and predictability. And what you're touching on is a bit the transparency. So first of all, data is on chain. And again, just to stress the point, I don't have more information and control than you have, Garett, in this product. We're on the same level field. So we have all the information. Maybe it's not so easy accessible. So first of all, I wanted to stress the information is out there. You have transparency. Compare that to a bank-linked stablecoin. That's why I say on these three aspects, risk, control, and peace of mind, there's a difference. And we have a Dune dashboard that collects all the data and shows all the loans. Actually quite nice. So you have bubbles, that was a big loan at this rate. So you have this bubble map that you see where do all these loan bubbles float. You get average rates and also in the UI that takes the on-chain data and gives you a bit a hint. What is the average rate? How much debt is in front of you? So how much debt would get redeemed until you get redeemed? So these are some clues where there are tools that are taking public on-chain data and helping the user to figure that out.
Okay, that's great because that's usually we know in experiments that in experimental economics that basically giving people a dashboard really helps them. And some experts, some people who are really into the details will dive in and create their own data sets and grab the data off chain, and that's totally great. But for for keeping the startup costs low, just knowing that there's a bubble map they can look at and see, okay, here's the way things are going. And it's, I assume, handled by, you're grabbing data from some kind of reliable Oracle or some reliable piece of software that
On-chain
sums it
data.
up.
It's just a Dune dashboard. Yeah, you just take it directly from the chain. And what does the data show? The model is great because, I said, if you funnel 100% from one side to the others, you are not getting taxed. You don't take any revenues out of the system. So it should be really efficient. And it should have the tightest spread. If there are a lot of users, it needs a bit more to get tighter. But it just has shown that we had usually very low or the lowest and most predictable rates kind of in the past year, just because the system is built so efficiently. I pay you, it's peer-to-peer finance, there's nobody in between, nobody that we need to finance. And that was really cool to see.
Okay, I want to turn to the governance question here. So there's going to be some, in this system, there's going to be some way for the rules to be changed by participants down the road. So it's slightly mutable in some way. Tell us a little bit about which parts of the protocol are immutable, which aren't, and what the decision rules are.
Yeah, so it's very, and I said there's no governance drama, the rules can't be changed. So I would say liquidity, the stablecoin, the borrowing system is immutable, predictable, because nothing can change how borrowers and stablecoin holders interact with each other. The only thing, where we added some flexibility, which doesn't add to the risk of the stablecoin and so on, is 25% of the revenues is geared towards liquidity pools like Curve, Bold, USDC pool, which is used as incentives to attract liquidity. So token holders can just vote where it makes most sense to allocate that, or if there is a new DEX, it can be added and allocated there. So just, okay, where do we want to have liquidity or these incentives going? That's the only thing that can be influenced by the token holders.
So it's liquidity pools, deciding, because those may change over time.
Exactly. Where do the incentives go?
People understand, yeah.
Yeah, but all the other parts, so it's very auxiliary and in the core logic and system and rights. You can't upgrade, you can't freeze anything, you can't, there's no triggered pause mechanism or so. So you have really full predictability, and that's something also people like. That's why I say the one thing is a bit the peace of mind, because if you look at some stablecoins that within a half year move from Fireblocks custody to fully on a centralized exchange, it's really hard to keep track what kind of risk are shoveled around in some of these stablecoins.
What guards in place do you have to make sure that those voting rights don't get abused, where someone just says, I'm the owner of X liquidity pool and I want to move 80% of the stuff to my liquidity pool?
Yeah, so what we did is, again, to align interest. So you need to stake LQTY. The longer you stake, the more voting rights you get. Mm-hmm. So the interesting thing, again, I think we have a lot of innovative mechanisms. You have seen the interest user set rates, and here also the locking. It's not like in Curve, you lock for 4 years and then you're locked. You're locking it and you accumulating more and more voting rights. So if I'm a year in there, I have much more voting rights if you have the same amount of tokens and just get in. But if I get out, I lose them. Mm-hmm. So with that, we want to align long-term interested people in the growth of the protocol, or we give it to their hands. If they choose to say, let's do it short-term, okay, they will hurt their own future. So that's how we try to give the ones that are most aligned the most rights.
Okay, so there's a political economy question there, right? Like in real life, countries don't do this, right? One vote is one vote. And but I think there's something really to be said for this approach, that people who are longer-term residents of a particular ecosystem, whether that's financial or political, they deserve some sort of extra voice. It's a sign that you're more committed to the game here.
Or if you pay more taxes.
I think that's just interesting political.
Yeah.
Or if you pay more taxes. Yeah.
That you also say what's done with these taxes.
Yeah. This is another one of these issues where modern democratic norms started with the French Revolution and even before, even the ancient Greeks. One man, one vote is a really incredibly strong focal point. And it's really only in the worlds of finance where people have been able to break away from those focal points and choose something closer to $1, one vote in the shareholder world, or in your case, something more like 1 year, one vote.
And the cool thing, that's why I love DeFi, is we can try it out, these things. We didn't have interest rate in V1. We have user set interest rates, all things TradFi guys have never seen. We can do that with the votes, and we can build these systems. And I think that's just so powerful. And I think that's I'm also very proud of what we have been able to achieve so far to implement these things and really use the technology in a way I think it was designed. And again, I'm not saying we are the best and it's only bold to stablecoin. I think the great thing is having these options and understanding these options and being able to choose. And I think there we just provide one option that otherwise probably wouldn't exist. There aren't many protocols, and I mentioned it to you. People might not know, but these trustless stablecoins that have all the collateral on chain, give you other guarantees. It's less than 1% of the whole stablecoin market.
Yeah. So to return to this rating and safety question, we at Bluechip have decided that Liquity Bold will get an A- rating, which is an exceptionally high rating. There's one online protocol that only lists stablecoins that are rated B+ and above by Bluechip. In my own personal life, if I had an Indonesian grandmother who I was trying to give advice to, B+ would be my cutoff. Say if you save a little money with a B+ rated stablecoin, that's okay, and you're well above that. It's also worth noting that fiat coins, these ones that are backed by things like treasuries, they have a narrower range in the middle. And there are a lot of sort of B's and C's. And in the world of DeFi coins, which are crypto-backed coins, we basically have you up at the top and a couple others that are doing there. Liquity V1 is up there with an A. And then there are a bunch of F's. So the world of DeFi is a world of some things that we at Bluechip think are quite reliable and are absolutely grandmother worthy, and then a bunch of things that are very troubling. Why do you think it is that the world of DeFi seems so high variance compared to the world of fiat and in stable coins?
Well, it's difficult to say. Also on the fiat side, I think there you see all the variants. But of course, it's because it's so much easier to spin that up and experiment. A lot of these stable coins are just some money markets funds that do crazy stuff and you have no idea. And just because people don't understand, regulators haven't catched up, it's still possible to have this Wild West. So in my imagination in the future, we will only have these highly regulated ones like Genius Act. They will be all commoditized and very similar. And great stablecoins. I really love the Paxos stablecoin. It really gives value to users because it's a safer dollar. And I think there will be the decentralized one where you need to trust the code, but where you remove a lot of the traditional financial risk, like counterparty risk, custody risk, operational risk, and so on. And I think all in the middle, this mesh in the middle, as soon as you move from one position into the middle, you're just adding risk. And one thing is you can build these, so that's why it's done. But the other is that people don't understand. That's why I think your product is so important, because moving in, you can add risk in so many ways. It's really insane. And people are not aware and just chasing 2-3% more and don't realize how much they take on. So with them, it's just a trust me bro zone, and it will disappear. I think it's still possible. But if people realize, okay, I'm giving my stable coin maybe to your son in the garage. He owns it with two guys, and then he thinks, I do something and then I paid 10% and I have no idea. And in 100 days, he has another idea and runs around with that money. And people maybe just don't have the attention span to follow that and realize and get frightened. I already get frightened if I have my money in the bank when I know what they do, because my money isn't sitting there. They are also gambling in a regulated way, but still, doesn't make me feel so safe. That's why I say I rather have it with Paxos just sitting there and knowing I can get it back. But I think, so to end, long answer to your question or shortening it up, I think because it's so easy possible, you just get the money and you can do it, and it's not, the regulation didn't catch up, because honestly, a lot of these things, are just in a zone that is today regulated in the traditional markets, and I don't see a way why it shouldn't if somebody controls your money and moves it around, if that should be different if he gets it on the blockchain instead of a wire transfer.
Yeah, at Bluechip, when we rate fiat-backed stablecoins, we place a lot of weight on basically the legal system the protocol is registered under. With DeFi coins, we don't do that. And because we take it for granted that we believe that code is law, and so we rate the reliability of the code. That said, do you think have international regulators shown much interest in DeFi stablecoins like yours? How do you interact with these international regulators, and basically what's their attitude toward you?
Yeah, I think they are still busy regulated, the centralized ones, like we've seen with MiCA. DeFi was carved out. So you could say it's not regulated, peer-to-peer finance, and it should be honestly okay. And it should also have a different regulatory approach. It's more like, because it's technical risk. So it's like more like product safety is handled. It's maybe the better approach than regulation, like trying to introduce an intermediary that you have somebody to regulate. I really like what the Clarity Act is doing. I think also saying we need to regulate stuff, but we see also if something is decentralized, if the control isn't there, it seems to be viable and feasible. So I think that's really nice to see, because I think that's really the battle we need to fight, that we can keep this option of peer-to-peer self-service finance. I think that would be really a loss if we just could say, okay, we can keep the monopoly of TradFi and we would lose out on that option. In the US, I'm optimistic. In Europe, I wasn't, because I felt they just want to have intermediaries they can regulate, and everything else they will cut off, which I think would be really a pity, and we should fight for. To keep this option, again, it's like freedom of speech. We as users and citizens should have these rights and not rely more and more on these parties that we didn't vote for that have suddenly so much control. Just talk to somebody today that said, hey, people are moving their gold to Switzerland. And just because they don't trust these governments, or where is my money, where are my treasuries, you see how people are worried more and more. And that's why these solutions get more and more important, to keep my freedom and my property rights, and I have control over it.
Yeah, speaking as a narrow economist here, I love the experimentation element of DeFi, the people who tried new things. As a person, as a citizen, I have a lot of sympathy for freedom of speech, letting people try things, but I just love the fact that DeFi protocols are creating new data. So here's one thing I want to ask. A year or two from now, after we have a fair amount of data on reference rates on Bold, what do you think they'll be the most correlated with? Will they be moving with US Treasuries? Will they be moving with whatever rates being paid on Tether or USDC? Or will they be moving with European rates? What do you think they'll move along with on average, if you had to guess?
Yeah, I think it will be a mix, because for me it makes sense if I think of what are my alternatives as a stablecoin holder. So there could be treasuries, and it will influence whole DeFi as we have seen. It can be if we have another crypto DeFi summer and there is just tons of incentives that can be sprinkled out, and I get on every stablecoin, I don't know, 3-digit yield, then of course everybody will flock to them, and it will put a lot of pressure on this reference rate too. So the forces can come from different sides. I think treasury is very important, but also the incentive situation. So we have seen that recently the stablecoin yields in DeFi went down, not that much like we would have expected just because of the treasuries, but I also think because everything cooled down, incentives aren't paid out so easily. It's an overcrowded space. So now it's much more conservative.
Yeah, the era of basically subsidized rates is pretty much gone, right? And so we're seeing something closer to market rates.
Yeah.
So there's going to be a generation of young finance scholars who are going to, I hope, will crave the data that you and other DeFi protocols are creating, because we know a lot about fiat rates, right? And we know a lot of things move together with fiat rates through arbitrage, through the law of one price. And a great question in finance is always, what is that one price? What is that safe rate that so much of the rest of the market will have its rates pinned off of? And I'm curious to see whether DeFi, whether the crypto protocols end up having, in a sense, their own rates, their own correlation structure, their own correlations across other markets that just tell us something new about the world. To me, that's as an economist, I'm curious about that. As chief economist at Bluechip, I care about safety, and I'm very glad that Bold has received an A- rating. I hope that other DeFi projects come out with and are able to achieve great ratings like that. Fiat is dominant right now. If you're trying to give somebody a pitch for why they should give a shot to your protocol rather than just going with one of the big fiat ones right now, what would you say?
One big thing is really risk diversification. You have just a lot of the same risk with a stablecoin, and I think Bold adds a different risk profile, totally uncorrelated yield. It's the only A-rated stablecoin without counterparty risk, cost of the risk, and a lot of other things. So allocating maybe just 5% to it can make a lot of sense. From the risk perspective, it gives you also benefits. You have full control over it. You can redeem against Ether, which is very liquid. It can't be frozen. It also gives you more control on that side. And also, for example, for institutions, so we had risk, the control thing, and as I said, peace of mind. There it's the transparency, gives you security, and the predictability. Rules don't change. And so I think these three things are USPs of Bold, where I think no other stablecoin can compete in that is A-rated. So that would be really my advice, and I really see it as a diversification game. I understand USDC and USDT, you need it for payment, it's great. But as I said, for grandmother savings or for crypto people or treasuries, having some part in that, getting it, I think, good risk-adjusted yield, because you're not taking much risk on the stablecoin, not on the yield side. It's not cross-chain. It's technical and Oracle risk. So I think you should hold in a diversified stablecoin portfolio, such as stablecoin.
Great. And let me close with a hard question. So you're choosing a code and you're going to stick with that, and it will be more or less immutable along all the important topics that people care about. What do you think, how should people be thinking about the fact that maybe there will be a better code coming along later that they'll wish they could switch to?
They always can. It's an open system. That's great. We also had our V1. And that's like the cool thing, public goods and competition, like forks. Somebody could fork us and do something better. And it's great for users that they can switch. Right now, we think what was missing on Ethereum, or still is missing, is something like the Ethereum dollar. We like to call Bold the Ethereum dollar because it's really rooted in Ethereum, just backed with Ethereum. So if you believe in the values and want to hold a dollar that is really close to your ETH, we are the ones. Maybe somebody comes up with a design that doesn't need an oracle. That's one of the risks we have. I think it's great for the ecosystem. And then people say, okay, it's new. I diversify one part, or I like both, or there's another risk, and they should be able to choose. So that's why I'm really advocating not just for our protocol, but having the options. What I love about blockchains, it's giving us options to have Bitcoin or a sovereign state. And that's, you as an economist know, adds competition, and just having this option to not needing to rely on a stable coin from a central issuer creates good incentives for them to create good products and behave in a good way. So I think that's really important. And to answer your question, yeah, that can happen, and people are not trapped. With one click, you can move out. That's a great thing in DeFi. If you have a portfolio in a normal bank, try to migrate it to another bank. In DeFi, it's several clicks, and you can move freely your asset. And I think that's probably what I value, maybe also you value. So this possibility should be given, and yes, it can happen. And maybe one day we come up with even a better system, and then people should be able to choose and go with that.
Thanks very much, Michael. This is Michael Svoboda, CEO of Liquity, which has created Bold, a new stablecoin that's being released soon. And it received an A- from Bluechip, which is a very high rating. And we look forward to keeping track of the progress that Bold makes over time. Thanks very much.
Thank you, Garett.